Right, so we've looked at our 5 types of adjusting entries. We had prepaid expenses, unearned revenue, accrued expenses, and accrued revenues, and we finally went through depreciation or amortization. So all of these entries were updating our revenues and our expenses and our liabilities or our assets at the end of the accounting period. And there's 2 hints that I've noted here that you can remember when you're going through and doing adjusting entries. The first one is that the entry never includes cash. And just to specify, these are just adjusting entries at the period end. So we know journal entries throughout the period when we're actually doing the paying of cash or receiving of cash. In those journal entries, we use cash. But when we're doing any of these 5 adjusting entries, they never involve a cash account. And as well, the adjusting entries are either increasing a revenue, so they would credit revenue, or they will increase an expense, so debit an expense. So we will always have one of these 2 going on. Doesn't tell you everything, but it gives you at least a little hint if you're not sure what to record in your entry. Never cash, and it will either increase a revenue or increase an expense. Because we know it's telling us it's time to recognize an expense that's been incurred, or if the revenue's been earned, we need to recognize that. So we're always increasing one of these. The textbook goes through these kind of breakdowns of how adjusting entries work. So when we look at the prepaid category, which is our prepaid expenses, they categorize amortization here and then unearned revenue. So remember, this is where we said the cash always gets paid before the expense is incurred or before the revenue is earned. So this is the original entry, the journal entry. Journal entry that happens sometime during the accounting period. So the cash comes first, but when we pay that cash, we haven't had the expense or the revenue yet. Then as time passes, we actually do incur the expense or earn the revenue. So the adjusting entry at the end of the period is needed to actually recognize the expense or the revenue. So prepaid insurance, we had the benefit not yet, so it went into this asset account when we first paid it. But then as the months or years go on, we have to record the expense as that has incurred. Same idea with our PP&E and amortization. When we buy it, we've got that future benefit, so it goes into the asset account. But as we use it, we need to record or allocate part of that cost into the expense over the estimated life. So later, we record the expense. For unearned revenues, we get paid before we've done the work or before we've earned that. So it goes into unearned revenue, which is a liability. And then over time, we actually do the work, deliver the goods, so we earn that amount. And when we do that, that's when we book the revenue. So for these prepayments, we get the cash first and the expense or revenue comes later. So our adjusting entry comes after we've already recorded the cash side. Now, accruals are the opposite. So we have to recognize expenses and revenues first. And then the cash comes later. So if you remember accrued expenses, we said we incurred the expense, but nothing had been recorded or paid yet. So we're recognizing the expense and a payable. For accrued revenues, we've done the work, we've earned the revenue, but we haven't got paid or nothing's been recorded. So now we're recognizing the revenue and we have to set up this receivable. So that comes first, and then later the cash actually changes hands. So these later entries are again journal entries that are made once cash is paid or received. So we get to the end of the pay period, we actually go and pay the salaries payable, and we see the cash going out. If it's accrued revenue, we collect from the customers, so we decrease AR and we increase our cash at that point. So just another way to think of the timing of those. For our prepaids, cash comes first, expense revenue later. For our accruals, the expense and the revenue comes first, cash comes later. So we've just gone through all of those different types of adjusting entries, are step 5 in the accounting cycle. And you see here that step 5 is to journalize, to record those entries and to post to T accounts. So it's just combining these two steps into one. So step 2 was just record journal entries and step 3 was to post. But step 5 is both journalizing and posting the adjusting entries. When we do this, so we journalize and we post these entries, we also need to calculate the updated balance in our T accounts. And from that, we will actually use those new balances and prepare an adjusted trial balance. How do we get these ready while we prepare an adjusting trial balance? This is step 6. And this just walks through the steps as we saw in the previous slide. So we start the adjusting process with an unadjusted trial balance. That was step 4. So we recorded our journal entries, posted them, created that unadjusted trial balance. Then we move on to step 5, which is actually recording the adjusting journal entries and posting those. So we're recording and posting adjusting entries in step 5. We go through, we calculate the updated T accounts, and now that we have new balances in our T accounts, we need to also create a new trial balance, and it's called the adjusted trial balance. So this is step 6. And we're not going to walk through an example of that. You do it in the exact same manner that you created the unadjusted one. It just has new updated balances. So that's really the only difference. And then step 7 is actually preparing the financial statements. So we've looked at that in chapter 1 as well. So step 6 and 7, we're not going into detail. We've talked about these elsewhere. It's just updated amounts for the adjusted trial balance, and preparing the statements is exactly what we looked at in chapter 1. So just for a really quick review of the financial statements, we won't look at an example, but just a reminder of what they are. We always start with the income statement. So that's the first one that we prepare. And on the income statement, we list all our revenues and we subtract the expenses and we calculate what? Right, our net income. So that's the first statement. The second statement we prepare is the statement of owner's equity. And here we start with our opening capital balance. So the owner's capital. We add net income. So that is why we need to prepare the income statement first, so we can add that there. We add any investments by the owners. So any more money or assets that they put in. And then we subtract any withdrawals from the owners. So any money they've taken out for their own personal use. And we get to our ending capital balance. So that is what is done on the statement of owner's equity. And then third, we prepare the balance sheet, which lists our assets, and it follows the accounting equation. So it's our assets equal our liabilities plus the owner's equity, or this owner's capital. And that is this amount. So that is why we need to prepare the statement of equity first, so we can use that on our balance sheet. Also, when we're preparing each of these statements, remember we need the heading at the top that has the name, the title of the statement, and either the date, so as at a date, or the period of time that is covered. And then the body is just all of our numbers in there. So just a quick reminder about the financial statements. You can look back to Chapter 1 for more detail of how to prepare those. So now we've gone through steps 1 to 7. And the textbook always goes through just some ethical thoughts about the chapter that we're on. So when we're talking about accrual accounting and doing our adjustments at the end of the year, we know the rules that need to be followed. That's what we talked about. We need to recognize revenue when it's earned and record and recognize expenses when they're incurred. So we know the rules, we know when to do this, but we actually have to have these ethics in order to follow the rules. So it says here there's this judgment in accrual accounting, and there is and there isn't. I mean, you can kind of go back and forth on some of these criteria about is revenue really earned or not, but these rules are in place. So you need to have these ethics to properly apply the criteria, make the accurate decision of when or when not to recognize, and ensure you're doing that in the proper period. So if you weren't doing that, you could have these biases or have some manipulation where maybe you overstate revenues. So you move or recognize the revenues before they're actually earned. So having a higher revenue makes the statements look better. As well, you could decide, hey, we're not going to actually accrue an expense even though it's been incurred. So that's wrong. But if you decided to be unethical, you could understate your expenses and wait and record them later. So this also would make you look better, but it's not accurate. Basically, the textbook and the rules in accounting, they're just saying, hey, yes, here's the rules, but you need to have those ethics as an accountant. You need to follow the standards of professional conduct and act ethically so that the statements are accurate. Difference between ASPE and IFRS, we're not going to go into detail here. The real only difference that you guys need to be aware of right now is that they're named differently. So IFRS uses depreciation. I've said that we can use either in this case, so just a minor difference, not something to focus on. And I just want to note that you are not responsible for Appendix A. So we do not need to cover the appendix in this chapter. So it just looks at other ways to record prepaids, but it's enough for you guys to learn the way that we've done it. So you do not need to cover Appendix A. There's no need to look at that for this chapter. And with that, that is the end of Chapter 3. Go ahead, do some practice, look at some more examples, and I will see you in class next week to go through some more of this.